Good afternoon, everyone. I hope everyone is having a wonderful week. Thank you so much for taking the time to join us here today. We really appreciate your attention and willingness to participate. My name is Akshay Sardana. I am the VP of International Development and Strategy at Continental Group. A brief intro into who we are for those of you who don't already know. For the past 25 years, we've been supporting our partners and clients with access to innovative solutions and world-class service standards. At Continental, we deeply understand the needs of our clients and go the extra mile to position the most relevant solutions. And along the way, we've developed a strong expertise and a proven track record of generating consistent growth for our clients. We are extremely passionate about what we do, and hopefully that comes across in the content and speakers we have lined up for you today. Our goal is to support you with actionable ideas you can build into your portfolio in 2021 and beyond, while being fully transparent and hopefully having some fun along the way. First on the agenda, I'm delighted to introduce Mr. Vivek Ahuja. Vivek is a portfolio manager and research analyst for Templeton Global Macro. He is responsible for the analysis of macroeconomic trends and developments in Asian emerging market economies and financial systems. He joined Franklin Templeton in 2006 and has over 17 years of investment and research experience in the fixed income markets. Our second expert speaker is Mr. Marwan Haddad. Marwan is a senior portfolio manager on the Emirates NBD Asset Management Equities team, where he's the lead portfolio manager on the Emirates MENA Top Companies Fund and associate manager on the Emirates MENA Opportunities Fund and ENBD Saudi Arabia Equity Fund. He follows a high conviction, adaptive, and deep research investment approach, which is value-oriented with a strong preference for companies that exhibit competitive, innovative, and efficient traits. He builds portfolios on long-term commitments with investments made after rigorous qualitative and fundamental analysis. I hope you're all looking forward to their insights into the opportunities of the coming year as much as I am. Also on the panel today, I'm privileged to introduce to our very own Neelam Verma, Vice President and Head of Investments at the Continental Group. Neelam is a seasoned finance and banking professional with over 23 years of experience across investments, private banking and wealth management, corporate and commercial banking, real estate finance, retail banking, and Islamic banking across India and the UAE. She has built her experience and career working in multiple senior positions across global banks like Citibank, HDFC Bank, First Gulf Bank, to name a few. We are giving you unrivaled access to these three experts in their fields, and we encourage you to ask them challenging questions and provide us with any feedback so we can keep improving. And on that note, I really hope that you enjoyed today's session. We are here to share ideas, collaborate, and help add value wherever we can. I would like to open the floor to Mr. Ashok Sardana, founder of Continental, to give you some more insight into who we are and how we're trying to change the world. Thank you very much.
Thank you, Akshay. I thought we were going to go straight delve into the speakers because they came to listen to the speakers. Hi, everyone. My name is Ashok Sardana. I'm the founder of Continental. But I'm also, to let you know, I'm a salesperson. I go out and talk to my clients every day. And I'm passionate about what I do. Continental is based on integrity, trust, and we are client-centric. Everything that we do has to be client-focused, whether it is investments, insurance, or any services that we provide, these are client-centric. And I hope that you will enjoy today's session. We're here to build lifetime relationship with our clients. We don't believe in long-term relationship. At Continental, we don't, like I keep on saying, we don't believe in long-term relationship. We believe in lifetime relationship. When we talk to our clients for investments, it's how we can help them to be financially secure. How can we provide value to our clients? And this is the ethos of Continental. With this, I thank you very much for joining the session today. And Akshay, back to you.
Thank you. Should we start the presentation? I think let's on that note, let's begin.
Yes. Thank you, Akshay. Thank you, Thank you, Shok, and uh, thank you for the opening remarks. My name is Ansel Mendes. I'm going to be your moderator for the evening, and we're going to kick off the conversation with our guest. I'm sure all of you are excited to hear the views. I think this is probably one of the first webinars where we are looking at and consolidating both what's happened in this year as well as being able to peer into the crystal ball and look at what 2021 has in store for us. Before we begin, just a couple of housekeeping rules so that everyone's on the same page as to what the protocol is. Of course, given that this is a webinar, there's no need for me to ask you to switch off your mobile phones, which is something good. But I would request my fellow panelists to kindly do that. Um, the other part is that we are looking at about a 45-minute webinar that in duration. If you are unable to stay for the full time, while we do wish and encourage you to keep through the webinar because we have a Q&A session at the end, we will have this available as a recording. In case you don't receive it, you can drop a message to the team, and they will be happy to rectify that situation and share that with you. As I mentioned briefly, there is going to be a Q&A session where you can type in and put in your questions into the box that is available. If you look at the interface, there is a Q&A box that is specifically available. If you type in your question there, one of the panelists will either respond to it live, or we will type out an answer to your question. If you are unable to get to you in time with the responses to your questions, please rest assured that a team member will respond, or a panelist will respond to you post the webinar. With that, it gives me great pleasure to kick the first question off to Mr. Vivek Ahuja. Mr. Vivek, would you like to give us a bit of an opening remark, if you will, on the perspective that you've seen this year, as well as the business that you do?
Sure. Uh, I think in many sense, we all are happy that 2020 is coming to an end. I think it's been a challenging year for all of us, uh, given the pandemic. But there are a couple of key learnings, and navigating 2020 did give us an insight in terms of how important really is in terms of liquidity, how important it's uh, for any investor to have that nimbleness to be able to adapt into a different kind of an environment. Now, in 2020, one thing which was extremely striking before we got into the pandemic was that the policy space was very limited. Now, when we go back to the GFC time, or rather the pre GFC time, you would see that monetary and fiscal policy was reasonably available as a buffer for the policymaker to respond to the challenges. But when you look in terms of the early 2020, just prior to the pandemic, you would see the interest rates were already at, if not historical low, but close to those levels. We already had a reasonable elevated debt to GDP in the developed economies. And in some sense, it was a far more challenging environment for the policymakers really to respond. But we did see them getting extremely aggressive in terms of adjusting and uh, introducing stimulus, which did well in terms of capturing that unlimited deep downside shock and try to minimize the economic challenges via these specific reforms. But the critical thing really is also to keep a focus in terms of how the adjustment really happens, not just during the pandemic, but post pandemic. And I think that's one specific area where we as an investor need to focus on, is not just to look in terms of the current pandemic environment, but the environment post pandemic. What kind of a fault lines have appeared? What kind of an opportunities have come in? And how do you really play the fixed income market from a perspective of interest rates being at extremely low level? You go into Europe, you look at Japan, you have trillions dollar worth of bonds which are trading into negative territory. So as an investor, how do you really create value for yourself in this environment would be one of the most challenging, but one of the most interesting thing. And I think that's where really you would see differentiation coming in. There would be couple of big headwinds, but certainly there are tailwinds for us as an investors to capture.
Thank you. Very interesting indeed. And we'll get to some more depth with that in the questions that we follow. At this point of time, I'd like to invite Mr. Marwan to please share his opening remarks with us. Mr. Marwan?
Arvan, you're on mute.
Yeah, your microphone is on mute.
Yeah, sorry. As Vivek was mentioned, this year has been phenomenal, and I think a testimony of that is us, all of us being here, attending this webinar. Usually we used to be or meet face to face most of the time. So it will lead to a lot of changes, and I think just would like to start where Vivek ended, is like for us is we need to see how the future or how the world will evolve post this pandemic. But if we take a look back, I think the most or the key lessons that I would love to highlight is the importance of due diligence, the importance of patience in our markets. I'm sure that as many investors benefited from this year, mostly I would say probably ended the year not benefiting as they should have been, or probably sitting on huge losses if they panicked at the beginning of the year. So that's a real hallmark for investors, and the importance and focus on actually taking the advice, doing the due diligence, and having patience, and the ability or the necessity to really assess opportunities at the time as they come, and keep on updating your models. I think it's been very challenging. It tested the nerves and discipline of many managers this year. But I see it probably going to evolve much better than most of us expected at the beginning of the year.
Thank you. Thank you for that, Marwan. And yes, Neelam, would you like to share your opening remarks with the team?
I agree with Vivek and Marwan. This year has been challenging for all of us. At the beginning of the year, we saw 98% of the workforce in the office. Come March, 95% of the workforce who was at home. And we used to have face-to-face interactions with our clients. We used to go and have emails sent across. But there was a third element that got added. That was the virtual element, and that's what Continental actually thrived on. We got connected more closely with our clients through Zoom meetings, team meetings, and we felt that the nervousness that was existing in the market got a little settled down because our clients were very pleased and delighted that the advisors were hand-holding them at all points in time. We felt that this was a need of the hour. The nervousness that any investor carries today with regards to their funds, with regards to their monies that are lying in different accounts, has to be handled very, very delicately. This is exactly what we did. We spoke to our clients. The most important thing that came to our rescue was a very, very strong investment philosophy. This investment philosophy that we carried was based around two critical elements, which is the lifestyle of the client, how much of income he would want to have on a regular basis, what kind of buffer he carries within his portfolio. It helped us a lot to understand that requirement from the client, and we helped our clients to build around that. The second important element that helped us during the pandemic was the way we looked at the markets on a daily basis. So our team used to sit down, deliberate on a daily basis, understand what's going on in the ecosystem around us, what's going on in the capital markets, how are our clients protected, how is the client's portfolio looking today, is there an opportunity to book profits, is there an opportunity to participate at regular intervals when we see dips. All this put together, I think, made the client feel very, very confident about Continental. And we've seen that this year, actually towards the last 5 months, has turned out to be phenomenal in terms of our business. It's increased the confidence of our advisors and clients alike.
That's a great sentiment to have, and we hope that continues into the new year and beyond, and just gets better. Thank you for that, Neelam. Vivek, would like to get into a little more depth and talk about the fixed income space and the markets. And how did you see that pan out, and how did they deal with the uncertainty that was was there through the year?
Yeah. I think 2020 had a couple of things which was very, very different from a typical deep risk off environment. You would assume that duration should do well. I mean, if you go to exactly post GFC time, you would see duration actually adding a lot of value. But when you look at the calendar year 2020, JGBs have actually given you negative return. German bonds, a very small positive return. So, in some sense, what we witnessed in 2020 was that the massive liquidity which was injected by different central banks did see support coming in various sectors, various asset classes, but again, the impact was not really uniform. And the other aspect, really, which 2020 has magnified, is that some amount of disruption has been actually pushed to 2021 or ahead, given the policy blanket was so comforting that many of these shocks which should have happened really hasn't because of factors like moratorium, uh, temporary reliefs which different governments have announced, and all these eventually would have some repercussion because the economic shock was huge. It was not 2 or 3% collapse in GDP numbers. We actually are talking about deep shocks where economies went into double digit negative numbers. And to say or to extrapolate that it's just a couple of months of pain doesn't look really right. So I think 2020 did see certain amount of opportunities where we did see few of the assets post month of May or June did a good bounce back. But what really we need to look at is in terms of how the corporate balance sheet are able to weather out uh, the defaults, how the government balance sheets are able to normalize. Because when you look in terms of the fiscal deficit number, means they've been in terms of a kind of a war-like situation in terms of the huge spending and revenue collapsing. So, from an investor perspective, I think 2020 uh, did see a good amount of comfort coming from strong policy response. But there were part of the markets which did not respond in the desired manner, part of the markets which overshot and has kept couple of these fault lines to adjust in a coming period. But one thing which really is visible today, and as I mentioned in my opening remarks, is that if you have extremely low interest rate environment, the risk return payoff is really not there. How much more money you can really make by buying the long end of the curve. So the market would really try to seek in terms of uh, opportunities in the other side. It could be in terms of few emerging markets where you still have fundamentals, where you can see some good upside. But there's one part of the market where we really see uh, 2020 has opened up a gate for a good forward-looking basis upside is on the FX. And I think that is one place probably there is a more potential place to look into. But again, we really need to be more specific, more idiosyncratic in terms of looking in terms of how to place ourselves uh, for a forward-looking basis. But very critical really is in terms of differentiating about the economies where the pain is still pending, where normalization is not going to be even, and the disruptions are going to be very sharp. So, as my conclusion about 2020 is that it was all about the policy response. We did see a disconnect between the fundamentals and the valuation because of the huge monetary policy support, uh, huge fiscal spending, and in some sense, it has created a couple of expensive slots, but also created some good opportunities for forward. Sorry, you're on mute. Yeah.
Sorry. Thank you for that, Vivek. And just as a reminder to all of our attendees, please do feel free to ask your questions in the Q&A box that is available for you to be able to reach out to at this moment. The other part of the point that I'd like to make is we have a poll that is going to be coming up at this point. So for those of you who are participating, please feel free to answer the poll. The first poll question is a very simple one, and as simple as it can probably get, but holds a lot of meaning. What is the right age to start investing? So do submit your views. And while our audience is answering the poll, I'm going to go to Marwan. Marwan, what are your views on the equity markets in 2020? Marwan, you're on mute. You'll need to unmute yourself.
Okay, so I'm going to highlight it from an emerging market perspective, more or less, rather than the global equity markets, because this is where we specialized. And to be more specific, we're more specialized in our backyard, and these are the MENA markets and the broader SIMIA kind of a block. Emerging market perspective, low interest rate environment probably will make the life a bit more complicated for our fixed income fellows. But generally speaking, it should be supportive, especially on the FX level, and that gives a lot of comfort to many investors to allocate more to emerging markets, and it gives the countries fundamentally a breather with this very low interest rate environment to be able to lower their own interest rates, which we saw. I mean, we saw across the globe emerging markets cutting interest rate, and that gives them a breather to stimulate growth themselves and to minimize their interest expense bill. And this is a window of opportunity. Basically, we saw inflows. Inflows has been very strong to emerging markets over the past weeks. Every week we've seen $2 billion, $2.5 billion, $3 billion of inflows into emerging markets. So from history, if we're going to take, previous instances like post the global financial crisis and what we're seeing today, so equity market should do well going forward. But to be more specific, the way we deal about it at Emirates NBD is more of we're pure bottom-up shop. So, our selection is based on our discipline, philosophy, and we like to think that we are advantaged given that we sit here, we have a big team, and we sit in a region which is literally very, very, I would say, undercovered at so many levels. And even if there's a coverage, it will be basically for the large blue chips and not the broader market. So that gives us a chance to capture more opportunity. And in a different way of saying it, as long as we manage to find decent opportunities, we're happy. And the moment we start to get worried is when we can't find enough investment opportunities. And this whole environment might change where we move, might change the way we look at things, but definitely we can say with comfort that we have a very positive outlook, especially in markets like the UAE. We started to see a double overweighting by many houses, global houses on the UAE recently. And it's been our thesis since actually 2019. So we've been in this market for more than 2 years, or in that allocation of that market. Saudi, we know that there's a huge argument about being overpriced, but when you realize the dynamics of the Saudi markets and how certain sectors dominate the market, like petrochems and financials, and if you go to tier 2, you find many interesting opportunities. Especially our GCC markets, I would say the pandemic pushed us in a very or accelerated many reforms that we've been waiting for. It was very visible in the UAE, and this should benefit the UAE, I would say, significantly over the coming years. It allowed them to position themselves in a very favorable position in terms of doing business. Saudi, the reforms we started to see 3-4 years ago, I mean, and I would say I'll give it to the government that they did not stop during the pandemic, and actually they kept on going with their vision and investments. And that was very obvious from the loan growth, from the cement sales. You can feel it on the ground. Things are still as solid. And we expect that to fall into to 2020. So generally speaking, with low interest rate, a rebound in oil prices, and a decent strength in commodities prices, it should be all favorable to the broader emerging market, and again to our region here in MENA, the broader MENA.
Yeah, thank you. I think you've made some very interesting points, and we've living and working in this region. I think all of us can attest to the fact that the mindset has been fantastically progressive, and we've been able to weather many of the things through good government action and policy. So that definitely is, and if that's an indication, I think we're in for very good times in the year ahead. And I'm going to ask the team to display the results of the poll. So there we have it. I think, okay, everyone seems to have agreed between 18 to 25, 66%, I believe, is the right age to start investing, followed by the logical 25 to 35 and 35 years is 4%. I believe that that's the right age to start investing. Okay, we'll go on to Neelam. Of course, Neelam, no surprises there, being with Continental, which mainly looks at advisory and working with clients. What have you seen in 2020, and how have you seen the year pan out? What are your views on the investment side of things?
Okay, I'll take a step back here, Anselm, and start with saying that at Continental, we have a huge amount of passion trying to help our clients, whether it's individuals or institutions, to have better financial outcomes. Now, that has actually helped us overcome this year with a lot of flying colors. Why I'm saying that is because, while institutions have a very clear mandate, they have boards, they have committees, they have governance, which helps them understand their financial goals. When we look at individuals, there's nobody who's helping them. As an advisor, as an independent financial advisor, we've been able to actually handhold our clients, go and work closely with them, understand their goals, and make sure that those goals are as objective as possible. Now, the moment we talk about goals, we also look at what is the kind of philosophy they would want to carry, what is the kind of legacy they would want to leave behind, how would they want to preserve their capital, how would they want to continue investing and managing that money over a period of time. So that investment philosophy has helped not only our advisors, but also our clients to overcome a huge amount of challenge that was thrown upon by the pandemic. If I have to come down to the second part, our clients have been very resilient because they have been investing, like the survey said, very early in their life stage. And they do have the understanding of staying invested in hard times. We have encouraged our clients to make these policy decisions. We've actually encouraged the clients to say, stay invested, irrespective of the time and the market. We've been advising them not to time the market, rather. We've been asking them to focus on what is the time that we are in, what is the market that we are in, and stay invested. We've allowed them to rebalance the portfolio with our advisors' help. Wherever we've seen good profits, we've actually asked them to manage the portfolio, book the profits out, and reinvest and participate in the market at all the lows. We've seen quite a bit of those opportunities. I'm sure Marwan and Vivek would agree to that. Those opportunities were thrown upon several number of times during this year. And our clients have been able to take that advantage because we were tracking the markets closely and advising the clients through our policy reviews on a regular basis. So in a nutshell, Continental has been very, very clear about its investment philosophy and has stuck to it and has actually advised their clients to stick to that goal and not panic.
Sure. Thank you. And I think that's sensible advice. And I'm just going to switch to Ashok here for a quick one. To sort of segue into what Neelam has mentioned. So why should one invest with Continental, and how will it help the investor from your perspective?
Like I said in the beginning, we are client centric. We will offer the solution. We will try and understand what is it that you want to achieve. Neelam is saying stay invested. We had 2008 and everyone said, oh, this time it's different. Citibank has never closed down. Citibank could never go bankrupt. AIG could never go bankrupt. We stayed on. We recovered. 9/11 happened. Everyone said the same thing. Never, America has never been attacked. This time is very different. Now pandemic is happening and we're saying this time is very different. Stay invested, have patience. All these are part of the investment philosophy, which will take its own due course. Do not panic and stay invested. We are there to hold your hand. We're there to serve you, and we will always guide you right. That's why it's Continental.
Thank you. Thank you so much. And I think it is going to be time for our second poll soon. So that should be coming up shortly. But in the meantime, I'm going to head to Vivek. Vivek, how do you foresee the impact of the pandemic? There are elections that are coming up. There are other external factors. I mean, so we've looked at 2020. We've sort of examined that. What do you see going forward into 2021?
I think one of the big themes which we believe is going to play out in 2021 is selective depreciation of the US dollar, specifically against economies which have current account surpluses. And that really opens up opportunities in many emerging markets which have a good spread over the US Treasury and where the FX can also appreciate. So we are positive in terms of few emerging market economies uh, where we do see space for currency really to appreciate. And that really is also a factor of expansionary fiscal policy in US, which probably is going to be there for reasonable amount of time, limited monetary policy space, and that really is going to force dollar to see some amount of weakness, and many other economies which would have a much better macro dynamics and specifically driven by more stability, potential to normalize debt to GDP quicker, would see more attractiveness, more flows, and also would see a more constructive currency trend. So I think one of the themes really is in terms of look at few developed economies. We've been bullish in terms of Japanese yen, again a current account surplus economy, and does benefit in a more elevated risk off environment. And there are a couple of other names in Scandinavia which have better fiscal and monetary policy, fiscal space and current account surpluses, and try to then look in terms of more developing countries which really can give us a good upside in a broader low interest rate environment. So I think 2021 is going to be a bit different from 2020, and which would really allow us in terms of uh, opportunity via adjusting out of a stronger dollar theme into a more weaker dollar, given the monetary and the fiscal policy dynamics there. And even the with the new government coming in, I think one thing common about Democrats and Republicans is that they both agree about more spending, although they disagree in terms of how to spend. But in general, we do believe that fiscal policy is going to be uh, uh, accommodative and expanding in US, which again is challenging and negative for the FX. So one of the big themes for 2021 really is in terms of positioning ourselves into uh, selective non-dollar positioning, and there are a couple of good names which we really see potentially should benefit investor into 2021. The other thing about the coming year is also, which I touched a bit in terms of my opening remark was in terms of the adjustment out of the pandemic. And I think there would be a couple of places which would show some good opportunistic entry levels, and we would try to play them as they turn out to be. But again, we do believe that it's going to be quite a constructive year, as there are reasonable amount of opportunities, and we do believe there are many economies which have reasonable capacity to normalize with minimum disruption and give more refined risk return payoff.
No, absolutely.
There is one more thing which both Republicans and Democrats agree,
Mhm.
and that is Trump is out.
Thank you for that, and also, thank you, Vivek. And also, I'd just like to point out the next poll is coming on screen with regard to the ideal proportion of fixed income and equities in your portfolio. So while our audience answers that, I'd like to also bring up the point that Ashok made to the previous poll question, which was that every age is the right age to start investing, and I completely agree. If you haven't started, start now. Boss, would you like to expand a little on that?
Yeah, sure. 25 age 25 is good to start investing. Okay, before coming into investment, I'd like to say there are two kinds of people. First, who spend and then they save, and the second group is who save first and then spend. Ask yourself, which group do you belong to? We have to first save and then spend. Don't get into that habit of spending, and then I will save at the end of the month if anything is left. Nothing is going to be left. There are too many sales going on, there are too many opportunities. So first save at the top and then spend. Yeah, any age is at 25, probably you would not have too much of money to invest because your income levels may be low. But as you go along, you become more and more sophisticated, you learn more, your investment philosophy changes. At 25, probably you can take more risk. But when you're reaching your ages of 60, 65, then probably you want to invest, you want your portfolio to be more stable. But yes, absolutely. Anytime, if you haven't started, and if you haven't started investing, you have to invest, because if you keep the money in the bank, you will lose out. The inflation is going to catch up and you will be losing money in the real value. So investments have to be there.
Thank you for that, and I think that very sensible and very wise advice. Um, the second poll has and should have ended. I'm going to get the results out there on screen, and that's right before we go to Marwan to give us his views with regard to the impact of the pandemic, the elections, as well as the other external factors in 2021. Marwan?
Yeah, sure. Well, this is a tough question for me, to be honest, for two main reasons. First of all, I mean, there is like the way we approach investments is honestly, we try to focus as much as possible on the fundamentals of each and every underlying company, and we try to assess on a probability basis, let's say, and under different scenarios, what will be the impact on the company, let's say, by certain major factors that affect its fortunes, whether it's cost, whether it's the price of a commodity, whether it's macro growth. But at heart, we keep always between 3 to 5 years invest horizon. So we believe if we stick to management with a decent track record, and that kind of the policymakers will react accordingly, even on the political, fiscal, or monetary levels to certain challenges that surface, we should be okay. So, and in a different way, we ride it out when we believe we have the right name. Of course, sometimes we're gonna be affected by, let's say, major events. We saw the pandemic taking place, but I honestly say we mostly try to ride it out, and we changed probably our allocation to different companies, given, let's say, we expect now interest rate to stay low for 3 to 5 years. So we probably reduced our banking allocation. But the big picture is always we run scenarios and then we assess probabilities to these scenarios. And as information improve or changes, we change the probabilities. And this is how we pick eventually our company. So whether it's Republican, whether are Democrats, whether it's Trump, whether it's pandemic, whether it's, I mean, one thing is for sure, and I can assure everyone, within a 3 months horizon, there's always something bad. You cannot escape that. Around the corner, there's always a monster. And that's gonna keep you, you know what I mean, very scared. There's always gonna be the all-time high PE ratio or the adjusted EV to I don't know, to the sun ratio. There's always something bad. The ultimate, as Verma said, is to stay invested, because this is the biggest risk, to maintain your asset allocation and to take advices from expert, but eventually you need to do your own homework. So
Marwan, we seem to have lost your audio.
maybe the pandemic will affect, and this. Sorry,
we lost your audio for a bit, but yes, please go on. I think we can hear you clearly now.
Yeah, I'm saying the pandemic is definitely going to change things, let's say, for forever, and it's going to affect things, certain other elements momentarily, like probably aviation sector will be slow to recover because, probably it's not into 2021. Probably the dynamics within the sector will not be the same. Maybe we're going to see much more intense competition from large carriers over low-cost carriers. Tourism probably will start to pick up in the second half. So there will be a cyclical element there. Probably the adoption of technology will de-accelerate, but it will not shrink, that's for sure. It will stay strong. And that what investors need to take into consideration when they're assessing the opportunities that are around them. But if you are diversified among asset classes, within, say, whether it's 80-20, 70-30, that depends on so many risk appetite, willingness, abilities, etc. And probably you guys at Continental are the best to help your clients to assess the best asset allocation. But again, eventually you need to stay invested and never try to time the market, because even if you manage to do it once, maybe twice, maybe you manage to time the market 5 times, maybe 10 times, maybe 20 times, but you can't just keep on doing it forever. So maybe I didn't answer your question, but I hope that I explained why I can't really answer the question.
No, thank you so much. I think yes, it is. It is an interesting times that we're living in, and you certainly put a good perspective on how to look at things. And I particularly liked what you said about timing the markets. Very often we tend to look at the opportunities from that lens. And I can't recollect. I think it was a Mark Twain quote that said, the best time to invest in the market is. The best months to invest in the market are January, February, March, April, May, June, July, August, September, October, November, December. So it's not the matter of timing the markets, but the time in the markets, as is commonly said. So thank you for that. And with that, we'll pick Neelam and pick her thoughts on what she foresees as the impact of the pandemic, the elections, other external factors on the way things will pan out in 2021.
Great question, but Marwan actually has used a lot of my information, Marwan. Yeah, I think we agree with what Marwan said. We encourage our clients to stay invested, follow their investment policy statements, follow their asset allocations that they set out initially. We understand that staying invested in such uncomfortable times can be challenging. People get nervous, people panic. It's difficult to focus on what they expect out of their portfolios, but that's where we come in and help out our clients. We ensure that they stick to their investment policy, which is as prudent as it can get based on the information that they provide. So If I can go back, we look at about 5 different aspects when we create a portfolio. We have the modeling tools available within Continental to look at these 5 different aspects. So the 5 different aspects are investing. We're looking at spending. We're looking at borrowing. We're looking at managing. And the last part is preserving. So all these 5 aspects put together for a client actually makes us understand the investment policy that the client would want to have. And based on that, we create an asset allocation portfolio. So each portfolio is actually designed to a client specific need, because we understand a family, whether wealthy or moderate, has a unique requirement. Every family is unique, every individual is unique, everyone has a different requirement for income, has a different liquidity issue, has a different borrowing level. So we put all that information together, and let me tell you and highlight that at Continental, we use our fact find very, very diligently. We look at all these aspects which are collected at the time of initiating a relationship with Continental. We look at what suits the client's profile based on that fact find. And this has helped us through and through understand the client's requirements, whether there's a pandemic or no, because the client would want to stick through his initial objective throughout the process.
Yeah, thank you for that, Neelam, and I agree. Consistency is key and important. And I'm going to start with you again. So, what is the outlook that you carry for 2021 and beyond? Are you optimistic? Are you pessimistic? How do you see, or what is your view on that? Sorry, hello.
It's for me, Anselm. Okay.
Yes, I'm shifting things around a little and starting with you first.
Okay, yeah, I'm super optimistic. I'm an optimist by nature, and I feel we've put in the right checks and balances in place at Continental. We've worked really hard over the last 6 months to put together a lot of structure, a lot of operating procedures in place, which would help our clients to look forward to a robust asset allocation model going forward. We have policy reviews that we do. We update our clients regularly through Continental. The communication is there. And I'm really glad that we have this third pillar added, which is the virtual world. Clients are more forthcoming in meeting up over a Zoom call, which was not possible because of the busy schedules. Today, our workday has stretched from the 8 to 5 to possibly an 8 to 8, which allows us more time to look into what's happening, not only on the workspace, but also on our personal space. I think we're very happy to say that the next year that we're looking at is going to be more robust for our business. We have a huge product suite. We create diversified portfolios for our clients across this product suite. We're adding a lot of new providers, a lot of new funds as we go along. So there's going to be a huge variety to choose from. Our fund universe carries the top funds across the globe. Franklin Templeton and Emirates NBD being, the top performers there. So clients have actually a lot to look forward to in 2021 from Continental.
Thank you. Thank you for that. And I'm going to head to Marwan with the same question. I mean, in terms of 2021, your outlook, and are you optimistic about the years beyond?
Well, I can tell you I'm fully invested right now. So, and actually, I want to allocate more to certain companies, and just struggling actually to decide on which companies I need to take a bit, a bit of chips. So we are optimistic, and we are mostly tilted to, we believe the UAE should be a very strong market, specifically Dubai. We've been positioned there, and we expect it to perform really well, assuming that a vaccine should allow, I would say, global travel in the second half of 2021. So we should be okay. Our initial thesis for Dubai in March and April was, when do we expect, let's say, travel to come back? When do we expect tourism to come back? We realize the size of tourism for the UAE and its importance. We see the peace deal with Israel as well, supporting the tourism market and general market in the UAE. Israel itself has almost 9 million outbound travelers every year. and 1.5 million of those visit countries like Turkey, like Egypt, like Jordan. So if you get 5% of this 9 million, that should be 500,000, which is again not much in terms of Dubai, but it should help as well. And you know, Expo, probably a deal with Qatar as well, will fuse sentiment more and more. Weaker dollar, so you know, a lot of things are moving into their direction. And I must say, it's one of the places where they really create that mindset and kind of a safe haven. People are comfortable here. I think the way they dealt with the pandemic, we've seen how traffic almost increased by 30-40% when the corridor between the UK and Dubai opened. And so many people are coming to spend the winter here. So that supports our thesis. And above all, valuations. Valuations are definitely not demanding, and price is at the center of everything we do. So we always take valuation into perspective. Saudi, it's more tricky because, as I said, it's a market of many moving parts. It's much bigger economy. It's the region's largest economy. But believe it or not, we still 50% are exposed to Saudi or allocated to Saudi. And just to give you a perspective how we think about Saudi, this came from almost 20% year and a half ago. So you've seen how much we are allocating to Saudi. One big element in Saudi we see is a huge reform story. We invested in, let's say, Saudi electricity, which gone through a huge turnaround or reforms. The laws has been just put in place to support the company, dairy provider. It might be not really good, but actually I think it's good. If you look at Saudi over the past 5 years, almost the listed company, and including blue chips, 60% changed their senior managements. Maybe that's a bad thing in our world. We don't like when people change management, but definitely companies that we never looked at with the new managements, we're more than happy to look at. So they see the drive for change and the reforms. And another market we find exciting is Egypt. And markets that we're really not excited at all about. Markets like Kuwait, which they didn't do anything to the pandemic. Actually, they let the private sector to take most of the hit. And you see on one hand countries like Saudi and UAE trying to attract talent, countries like Kuwait probably and Oman trying to expel talent. So you see these are structural changes that taking place. So we're not really keen on Kuwait, Oman, and countries in the region like Qatar as well because of valuations. Egypt is a very interesting market, but you need to navigate it with pure, I would say, very, very vigilant and diligent eyes because you can get stumped there very easily. So that's around our regional markets.
Sure. Thank you, Marwan. And we're going to go quickly to Vivek and then Akshay before we head to the audience Q&A. So Vivek, would you like to give us a summary of your outlook for 2021?
Sure. I'm going to be very brief. So 2021 is going to be probably a year which needs to be looked from a different source of alpha. So when we really look in terms of curve, currency, and credit, we really think 21 is going to be more driven by opportunities and valuation adjustment on the currency side. Selectively on the curve, there are a couple of emerging markets where real rates are going to be still positive, which will throw some good opportunities. But in general, we do believe that 2021, the elevated source of alpha is going to be really driven by the currency. And we think investors need to really look at that part of the market a bit more seriously, which can throw some good opportunities, and then try to really look in terms of the broader geopolitical themes, which could be in terms of the US-China relationship, in terms of how Democrats really shift in terms of their spending pattern to populism in Europe, to normalization of policy. So those are my specific comments for 2021.
Thank you, Vivek. And Akshay, if we can get your views on 2021 and how do you see that the years 2021 and beyond panning out?
Yeah, just going from what all the speakers have said today, we have reason to be very optimistic because there's clearly going to be lots of opportunities. So we are extremely optimistic over the next year and coming decade. We've seen an incredible story play out over this 2020, and we've seen resilience in a way that we could have never expected, and is really inspiring. So on the roots level, if we've seen people come together and overcome adversity and navigate these challenges, then I'm sure that'll translate onto a corporate level and into the wider economy. But as you know, Vivek brought up opportunities in certain sectors and market that could recover faster than others. That's very interesting. And Marwan mentioned that monsters will show up every 3 months, so that alludes to the fact that we need to be prepared and ready to stand the course. And it's nice to hear that even a senior portfolio manager can judge market sentiment based on increased traffic on the road, which we have seen, and it is encouraging. So yeah, I think our view is to continue to support our clients, is to stay the course, and we surround ourselves and partner with the best in this profession. We are constantly adapting and connecting our clients with experts like Vivek and Marwan to navigate through these uncertain times. But just to, I've brought this up before, if we look back to the Great Recession of 2008, what came out of that uncertain time was WhatsApp, Slack, Uber, Groupon, to name a few. So I also foresee massive opportunities and new disruptions coming out of, especially in the healthcare space, the travel space, tourism space, certain emerging markets. I think there's just going to be a lot of interesting stories playing out in 2021, and we're here to be part of that. I'm very excited. And yeah, I think with the help of people like Vivek, Neelam, and Marwan, we will be able to capitalize on those opportunities in a big way.
Excellent. Thank you so much. And we're going to pick and take an audience question. We've got a few questions that we need to get to. The first one, I think this would be for you, Vivek. How are the MENA fixed income space placed for investments in terms of risk and return? This question is from Mr. Sanjay Motwani. Vivek, would you like to respond to that?
Sure. So I'm not a MENA specialist, but again, what we really see from a fixed income perspective, there are specific stories in emerging market world and also in MENA region, which throws an opportunity. And the only thing which needs to be looked at and focused is in terms of the potential for the economies to normalize post exceptionally loose fiscal environment and loose monetary policy environment. And I think that is going to be critical, because there will be a time where you would see inflation picking up, and you will see a time where the credit offtake picking up, and it would require a more finer balancing from a policy side. But again, I'm not a MENA specialist. I'm more in terms of global in Asia. So, but I do see in different pockets there are opportunities, but they need to be more filtered out in terms of which one really has a more potential stable and better risk return payoff. Yeah.
Sure. Thank you for that. We've got another interesting question, and this is by Dr. Suresh Nanda. I'm going to quickly sort of get that up, and it's up on screen. Post-vaccination, which sectors do you think would have better growth and profitability? Also, which industries are going to disappear? Anyone on the panel would like to take it? Marwan?
Well, yeah, assuming vaccination is here, probably, sectors related to the tourism. I think many people, I'm not sure how many of us, are just keen to get out, probably travel a bit. And I think so, therefore, tourism should be a very strong sector. Sectors which were affected the most by the whole thing should be a good investment, especially when valuations justifies it. But you can see that people already started to act on that, and probably now it's I'm not going to say a bit of too late, but in many places, people already banking on that. And the rally over November and December was mostly driven by, since the Pfizer vaccine news came out. What industries will disappear? I tell you, but whether it's like the pandemic or not the pandemic, maybe the pandemic will accelerate certain industries to disappear rather than is the cause of these industries to disappear. A huge shift we've seen is fintech. To be honest with you, I think fintech is a very interesting, let's say, challenger to the financial sector. Probably you guys at Continental realize that. Maybe you've seen the Lufax listing last month in China, and this is a very interesting model of how to do wealth management in a very, I would say, different way. Everyone in the financial sector will be disrupted, and I would give one advice to our investors: just look at who owns the client. When you see who owns the client, you know who's gonna survive and thrive. And when you see who doesn't own the client, probably gonna demise, and they will see their margins being eroded year after year till something happens. Regulation is a huge thing across the fintech and technology sector, so that's as well need to be examined very carefully. We've seen what happened in Asia and Alibaba recently as well. So keep an eye on the tech. I'm not going to advocate electric vehicles or anything here, but it seems that it's going to be a big disruptor. So, and generally, technology will affect many aspects. It accelerated many aspects of our life, and I'm not sure how many people will survive. Maybe in the logistics, maybe in the even healthcare is changing. And definitely fintech. Fintech is a big space, and it's going to change the game forever. And that seems it's a matter of time.
Thank you for that, Marwan. We've got questions coming in, thick and fast, but I'm conscious that we are almost out of time. I'm just going to take one last question, and that has come from our gentleman, Mr. Mohit Basim. Are emerging markets looking more lucrative to invest as compared to developed ones in 2021? If any of the panelists wants to pick that one up, we can start with Vivek.
Sure. I kind of agree that emerging market has more potential in 2021, given where the developed market appears on the valuation side. As I mentioned, most of the developing economies are at historical low interest rates. Very little space there really to make money. While on the emerging market side, we do see many of them having better macro potential. And in general, I would agree to that statement that EMs probably would have a better potential path in a forward-looking basis compared to the developed market. But again, the risk about putting the entire EM into a single bucket, so you need to differentiate between them and then try to look in terms of which one really fits well with the environment. Yeah.
Thank you for that, Vivek. There's been, while I did mention that is going to be the last question, I think there's a very interesting question that is coming on board that could have impact on the region, and we'll get to that. There's a question that is asked: is there a chance of normalizing relationships with Qatar? So, what would your views be on that, Vivek and Marwan?
Maybe I can start with this one. This is a pure political question, and probably it will take a year just to explain how we reached to that level. Rather, it's like, if you want to know if things will be over, you need to understand how they came to the current situation. But to make it as short as possible, I think Qatar needs to normalize things at least before the World Cup. The last thing you want to have is such a global event and your borders are closed. I'm sure that still many people will come from the region versus someone flying from Argentina or Mexico. So that's something that will push for this. And another thing, there are kind of two camps now in the region, and Qatar is on one I would say, side of the equation versus the other Arabic normalized states, which are UAE, Saudi, and Egypt. Neutralizing Qatar's let's say role in the other camp is of utmost importance for the new alliances that are emerging. So I see a resolution will take place, but it will be more of a tactical rather than fundamental, because fundamentally the directions are totally two totally opposite directions between Qatar and the region. So it will be more of a tactical rather than permanent, I would say.
Thank you. Thank you for that. The team has just reminded me that the webinar is until 4. My apologies. I was under the assumption that it is ending at 3:30, and that's why I was. So I think we have time for a few more questions that we can get to. The next question that is come from our audience member by Mr. Deepak is, what are your thoughts on which asset classes will do well next year? I'd go to Neelam. Neelam, do you have something that you'd like to suggest on this? Do you see any particular clear winners here?
I think all asset classes are expected to do well next year, provided they have their clear weightages in the portfolios. When we talk about any specific asset class, whether it's fixed income or equity, we look at what is the kind of investment philosophy or asset allocation the client would want to start out with, meeting his objectives. So I wouldn't go and pick and say that this asset class is going to do well, but of course, emerging markets are the area that one should watch out for. We would want to encourage our clients to look at the thematics now, look at the AI space, the technology space, to participate and get their upside kicker in their portfolios. However, this has to be done with utmost care and caution, because it should not exceed a certain portion of your overall portfolio allocation. So I would leave it at that, saying that we need to have a diversified portfolio with all kinds of asset classes underlying.
Perfect. Thank you for that. There is another question that has come in from the audience. I think the team is getting that up onto the screen shortly. I'm going to ask the question and that will come up. What are your views on US technology stocks in 2021? So there are two questions in one, also about the direction or movement of gold price in 2021. So I think we'll have to go to both Vivek and Marwan for this. Let's start with you, Vivek.
Sure. So gold, obviously, when we look in terms of a weaker dollar, expansionary fiscal policy around the world, gold does look constructive in terms of the backdrop. But again, for us, we don't invest in gold in our fund. For us, we need currencies, and we don't include gold as a part of the currency. But where the broader macro environment looks like, it does appear that there are more positives for the gold than the negatives, and should be more constructive in an expansionary fiscal environment and in a low interest rate environment.
Thank you for that. And Marwan?
Well, to be honest with you, I don't even understand why people would buy gold, but that's something of their own. I mean, just probably the hope of that someone else will buy it at a higher price, and probably the weakness of global currencies. I mean, like when you see all these huge QEs taking place, you wonder, for how long this will keep on going. But I've heard the wise guy once said, if everyone is easing at the same time, then it's a relative gain for you. So probably that's why some investors would prefer to hold some gold, just in case something happened. And on the technology sector, I mean, I'm not a US expert, but I'm an avid technology user. So I would say in a zero interest rate environment, anything that shows positive growth probably is going to continue to grow. But it's a huge sector, and we know that we saw a glimpse of the future in Q2 this year, when we saw Amazon bottom line doubling, or even Q3 when we saw companies like Nvidia, you name it. I mean, and the utility of the services they provide. So that gave us a glimpse into the future, and that thing says that probably as more people adopt these technologies, growth will continue. But when it comes to valuation, probably you need a US specialist on that level, and whether Tesla is a buy here or Amazon or any other stock.
Sure, I understand. Thank you for that. And we have another question that's coming from the audience member. While this is going up on screen, I think there are some questions that are repeated. So I think some of those have been answered. There was another question with regard to the best allocation strategy in terms of percentages and in terms of equity markets for large and mid-cap stocks. But I think that falls into the category that Neelam would have addressed with regard to the asset allocation. This one is with regard to the recent developments with Israel. What are the gains for the Israel partnership in the GCC and the UAE? And how do we see that? So I'm going to again put that question up to both Vivek and Marwan, if you'd like to address that. We can start with you, Vivek.
Well, I really don't have a strong opinion in terms of that regional political, so I'm going to give a pass to this one.
Sure.
Yeah.
Marwan, would you like to address that?
Well, Mendes, this is getting a bit too political between Qatar and Israel. Yeah, I mean, so again, from an economic perspective, it seems going to be positive. Say things like tourism, and definitely, I mean, security is very high on the agenda in the region, and I believe Israel is pretty much advanced on that tech. Cybersecurity, these are places where the GCC can benefit strongly. We saw some or a lot of political gains if the UAE manages to eventually get F-35s. I think that will change as well the regional power game significantly, and it should be positive for the region. So on paper, it's very positive, and I'm sure in the UAE you can. It's just becoming very visible all around the UAE, and I've heard that for the Hanukkah there are 50,000 tourists here now. So obviously it is positive for the UAE, and I think it kind of balances the regional power struggle a bit between the camps. I hope.
Sure.
I can't give more. You know what I mean?
Thank you. Yes, we've got a couple of more questions left, and we've got, that. Yes. How did you position your portfolio during March 2020? So I think this was just before the lockdown, sort of giving context to that. And what factors made you think you should add at rock bottom of the market? Again, we're going to go to, I think, Vivek and Marwan for this. Vivek, would you like to go ahead?
Sure. I think the 2020 could be divided into two phases. The first phase was really when you were in a kind of a infinite pit where things were just collapsing. Uh, and then gradually you did see the policy response coming in, central banks doing swap lines to manage the dollar shortage, QE announcement to monetary policy support to deep fiscal. So during that first phase where we did see that shock dominating the entire landscape, our focus was really to go more biased towards the safe haven. And what we really did was bought more Swiss franc, we bought more Japanese yen. We also picked a couple of other Scandinavian FX, which have both fiscal and current account surplus. And we did hedge many of our emerging markets. And now what we really believe is that with vaccines and economic activity picking up, it's more of a time to position for normalization, but again, trying to pick the ones where you have more visibility of normalization. So March 20, our focus really was in terms of being long safe haven, hedging out in terms of many of our risk effects. And as we move ahead, our attempt really would be to normalize and add more risk from an FX perspective and take the advantage for the coming years in terms of benefiting from the adjustments and opportunities in those specific aspects.
Sorry. Thank you. Thank you, Vivek. Marwan?
Yeah.
Like to look, yeah.
Oh, that's a very interesting question, to be honest. Well, we came into 2020 with a totally different perspective. We were really bullish on the UAE because it's an expo year, et cetera, et cetera. 2019 was a very strong year, and we started to see some stabilization in real estate. And everything that we thought would happen, that obviously the opposite took place. So January we were a bit watching, hearing the news, pandemic, Wuhan. We felt that probably it's too early. Maybe we started to think about other scenarios, like is it another SARS? Is it another? These kind of things that hit in 2003 and 4. By Feb, we decided to do a full analysis and to engage with our companies and companies we own and we don't own. So we wanted to hear from on the ground how things are happening. And our first school of thought is we want to cut, or we want to see where valuations are full in our portfolio, and to see how these companies are going to be affected given the situation in Asia. Because if you remember, between January and February, everything was okay except for Asia, we're under shutdown. So from our conversation, and I think this is where we got a bit slightly ahead of the game, is we are in constant conversation with the companies we invest in and with other companies that on our watch list. And we sensed huge weakness and complacency between the message we hear from what's happening on the ground, especially from companies dealing with logistics, because they have hundreds of clients across so many sectors, so you can get a decent feedback from them, and with how valuation of prices in the market. And we felt financial sector is under the biggest threat, given expected kind of a stimulus or cut in interest rate and quantitative easing. So what we did is, by end of Feb, I would say, and first week of March, we holding just decided to, let's say, where we see a limited upside in terms of valuation, 10-15%, and sectors that might be affected strongly and directly, we decided to cut. And so we ended up with almost 20% cash. This is very unfortunate, and we rarely do that. And I tell you, this is only the second time since the global financial crisis. And we decided to spend most of March on analyzing, putting scenarios and probabilities for eventual outcomes. Like for how long this will happen, if there is a shutdown. And at that point, there was no shutdown yet in Dubai or in the whole GCC. So what's the probability of a shutdown? And I tell you, till last day, we saw this as a very low probability. But we started to assess the situation, putting some scenarios and probabilities. And once everything kind of peaked by the end of March, and by the first week of April, given these scenarios, we started allocating. So just to give you an example, Emaar malls trading at 1 dirham, it was unrealistic for us. Unless you expect the mall will close down or even traded at 95 halalas. This was unrealistic unless you expect, it was trading at almost 15% cap rate. And this is, when you have a 3 to 5 years horizon, this is a very easy decision for us. So we started buying companies like Emaar malls. We started to buying companies like malls in Kuwait. We started to adding more to banks at extreme valuations in Saudi, which we were not actually. The portfolio changed a lot because the market reacted differently, which we started to add. And again, it's assessing the probability with each day and with each new piece of information. So we allocated almost I would say we came back to only 6-7% cash by the end of April. So we allocated most of the money by April, and then by May we were almost fully invested. So this is how we dealt, and I would say things more moved to our best case scenario rather than our base or worst case scenario. But at the time when we bought, the market was pricing a worst case scenario. So that was a fair trade for us at that point in time. I hope that answers your question.
Thank you for that. Indeed, it's a fascinating look at a scenario that.
Yeah, but with a lot of emotions, you know what I mean?
Absolutely.
We can't deny that. But that's why we have ourselves to stay true to the discipline and to the approach.
Absolutely. Thank you for that. I think we've had a few more questions that are there that we will get to post the session. Oh, sorry, 1 minute. We've got the last question that is there. And it is, with vaccines now available, how do you see the unlock scenario playing out? Is it already priced into the markets all over the world? Will it reach the markets higher, or will it be a sell on the news? So I think essentially this is coming down to, do you see the vaccine and availability of it already priced into the markets? Quick thoughts from both Vivek and Marwan, please.
Sure. So there has been a reasonable amount of adjustment already done in terms of the vaccine and post-normalization environment. But what really is going to differentiate is that there would be many economies which will disappoint and which would have to extend their loose fiscal and accommodative monetary policy for long, and you would see a correction there. But there would be many who actually would be able to normalize in a much more efficient manner. So it would not be wrong to assume that the market has been looking a bit more forward in terms of kind of a pre-pandemic kind of a environment, and trying to look in terms of how that normalized environment would shape out. But that does not mean that there are no opportunities or there are no potential shocks which will be visible. So I think the differentiation is going to get more and more magnified in 2021. Many of the assumptions which have been taken in 2020, that the recovery is going to be smooth and uniform, I think that really is going to be not true, and you would have both winners and losers. So in some pockets you would see probably the disappointment. In some pockets you would see that the opportunity is great, and I think that's probably the biggest question for us, is in terms of picking up the right ones to make sure that you are able to enjoy the upside for coming couple of years. And again, the focus needs to be looked in terms of the policy buffers available, uh, the willingness for the policymakers to do a couple of reforms to push things in a manner that you are able to achieve the potential growth in a more smoother fashion, but also really to make sure that you normalize your policies in an appropriate time. Otherwise, with that huge amount of liquidity and easy policy, you would see inflation really going out of control. So the answer is yes and no. There are some pockets which valuations look stretched. There are some pockets where you will enjoy the upside for a reasonable period of time if they get the policy story right.
So thank you, Marwan.
Yeah. Well, I mean, like, probably if you look at, the Dow, S&P trading at all-time high, you've seen the rally in Asian markets, China, South Korea, Taiwan. So even though that most of this is kind of triggered by a huge rally in tech, which benefited fundamentally from the pandemic. And while other markets are still lagging so much behind, but they're smaller markets. So I think that's the easy answer to it. Like, if a market is rallied and outperforming, probably most of that is already priced. And if the market is lagging so much behind, still, even like the UAE markets, even our regional markets are not really, moving in tandem with emerging or global markets. Probably there's still some room to it. But that's a very general statement. And I still believe in emerging markets, you're much better off with an active strategy versus probably more on the passive side in developed markets, where the market's much more efficient, where each company is covered by 100 analysts versus here. I mean, very few investors look at the market. So again, that's very general statement. It depends on the pocket, as Vivek said. You need to be careful how to allocate.
Sure. Thank you. Thank you so much, Marwan and Vivek. I'm going to go to Ashok. He's got some thoughts to share with regard to the markets and a few ideas that I think can be useful to our clients. Boss, would you like to?
No,
provide
these
your-
are not ideas. A couple of experiences that I'd like to share.
Sure.
Just before the webinar, we were having a meeting with one of our very senior advisors, and he was saying, during the last 6 months since the time of pandemic, no one has been able to travel, and probably these have been his best months. He says he has been able to gather investments from all his existing clients. They could not travel, he could not travel. He was doing all the Zoom calls, and he did massive business, probably his second best year. So we can take opportunities. These things will keep on changing. And we're talking about Zoom. Zoom is not a technology format anymore. It's a travel instrument now. We can travel with Zoom anywhere, anytime. People are asking, Marwan said, what does 2021 look like? Vivek said, how does 2021 look like? I don't have a crystal ball. If I had a crystal ball and if I knew what 2021 was going to look like, probably I would be a billionaire. But one thing which I know is I can control my attitude. I know what we have to do, and these markets will always keep on shifting. We will always have unexpected market conditions. So we have to stay focused, we have to stay invested. We do not have to panic. And yesterday I was tested positive for my attitude, not for COVID. So let's say positive, these things will pass. 2021 is going to be a better year. And thank you very much. I'd like to ask Akshay or someone to close. Yeah, thank you.
Thank you so much for that. I couldn't agree more. I think mindset and attitude determine how we will experience the year ahead. And I'd like to invite Akshay to give his closing remarks and a vote of thanks as well. Akshay?
Thank you. Just a really warm thank you going out to Vivek, Neelam, Marwan, you, Anselm, as well, for moderating, Ashok, for those inspiring words. This is what we do. We connect people, we bring people together. Thank you all for participating again. Please reach out to us, speak to us. If there's anything you'd like to see, if there are any follow-up questions to Vivek, Neelam, or Marwan, field them our way and we will get you those answers. Come to our offices if you are moving about and sit with us. We would be happy to discuss your long-term goals and to strengthen these relationships. As I said earlier, we are in the presence of experts, and as long as we get started and we stay positive and we keep looking forward, we will be able to benefit from the opportunities that lay ahead. We want to do many more of these, so please give us your feedback, as I mentioned before, because we would be happy to put this together. It doesn't take a lot of time. We don't have to travel. And yeah, thank you very, very much. Vivek, thanks a lot. Neelam, thank you. Marwan, thanks a lot. Have a great day, everyone. And looking forward to speaking to you again soon. Thanks.
Thank you, Akshay. Thank you, everyone, for joining in. And for those whose questions did not get answered, the team will be in touch with responses to your questions. Thank you. Have a great evening. Bye-bye.